Today what I want to talk about is how do you protect your portfolio from the inevitable storms that you will face if you want to play this game for the long term. Because we've just had a world record here in Australia where we've had over 25 years without a technical recession, which means that no other developed economy in the world has actually done that. So it's easy to think that the good times will last forever. I mean, we've just had a great property boom on the east coast of Australia. We've had low interest rates for some time. So it's easy to think that the sun will shine this bright forever. But there's a few things that we can do to protect our portfolio from the inevitable ups and downs that come through being through a cycle. And the first one is the number one piece of advice that I give to any client, and that's asset selection. It's unbelievably critical. And I remember investing myself through the GFC. I remember helping clients through the GFC back in 2008. And as I'm driving around, I'm noticing that the C-grade properties and some of the B-grade properties had for sale signs out the front. And C-grade properties often had 2 or 3 for sale signs out the front in the same development. And generally what that means is you've got zero, you're not sort of negotiating or selling in a position of strength, you're actually selling in a position of weakness. But as you continue to drive around the suburbs, you notice that the A-grade properties, no for sale sign out the front, and they weather the storm much, much better. So my advice is always the same. Asset selection is critical. We're looking for properties that have enormous owner-occupier appeal because that's what drives the market and we want to get taken along for the ride. And we want to avoid properties that are susceptible to volatility. And the obvious one, for example, is if we invest in a mining town. Sure, everything's great when the mining is booming, but now as we currently stand, the mining booms come off, and some of those investors in some of those towns are feeling the pain enormously. So my number one rule for getting through the storm is to make sure that asset selection is critical. Number 2 is to focus on the profit and loss rather than the balance sheet, which is an accounting term, which is essentially meaning focus on the day-to-day cash flow of your portfolio rather than the day-to-day change in value of your portfolio. Because I've been investing now for a long, long time, and I've spoken to people who've been investing for 30 years, 40 years, 50 years, and if you ask them, their growth on their balance sheet is not a linear line. It's actually gone up, maybe given a little bit back, it's gone up, but overall the trend is up, and the overall trend is exponentially greater the longer they hold it than when they first purchased it. But they've had a few ups and downs along the way. So don't get caught up if in the moment property values on the front page of the paper or all of the news headlines suggest that they've come off a bit, because ultimately if you're investing for the long term, it's irrelevant. Because what is actually important is you get the asset selection right, which we talked about before, but make sure that our cash flow is okay now so that we can actually get through the storm. And not only that, think about the things that are going to happen in the next few years. Maternity leave, you want to put your kids through university, whatever it is. But if we've cash flowed these events effectively, we can weather the storms of the fluctuating balance sheet because we know that we're playing the long game. Another thing to keep in mind is don't play red or black. And by that, don't gamble. Don't overcommit financially and take a punt on something that you think might come off, because these interest rates won't be this low forever. But also there's been changes to the lending environment which made being very aggressive 2 or 3 years ago makes some of those people look very, very vulnerable in terms of their lending structure and their lending strategy. So for me, don't play red or black. Don't sort of just play the gambling card. Do a methodical and well thought strategy and approach, which takes into account what we talked about, getting the asset selection right and making sure our cash flow is well looked after. And my next point is through that storm is if we've got a buffer in place, which takes into account 6 to 12 months worth of expenses that we have, will give us the peace of mind to know that we will be okay to trade through any sort of flattening out of the cycle, any negative news that comes. And it means we won't have that white knuckle ride. And it also means that the portfolio is strong and we won't have to get into a position that cash flow is tight and therefore we have to sell in a position of weakness. So I guess that's the really important thing. But my last point about going through the storm is if you get those first 4 right, you can actually be opportunistic. And by that, When it's a booming market, people would just love the opportunity to buy really great assets without competition. Now the challenge with that is when we go through a storm, those conditions actually exist because you can buy really great properties with less competition, which is what we hope for during the boom, but when it comes around we get nervous and we don't actually want to buy. But if we've done those things right, we've protected our portfolio, we have cash flows are right, we've got a buffer in place, we can actually take advantage of the opportunity that comes from the storm environment, because you're actually investing for 10 or 15 or 20 years. So you're not going to get caught up in the minutiae of what's going on now. So if you do all of those things right, you can take advantage. And it'll only be 5 years from now, you look back and you go, look at those great assets that I bought in a time that was quite difficult for the economy in general. So there's a few things that I think that people can do to weatherproof their portfolio to make sure that they're going to be okay. But I guess in conclusion, really what you want to do is plan for the worst, but be optimistic about the best. So by that I mean keep your mindset right to keep moving forward and building the portfolio for your long-term financial security. But if you do plan for the worst and make sure that the foundations are strong, you're going to be one of those few people that don't fear the headlines, that don't fear the storms that are coming, because you're playing the long game and you've set your portfolio up correctly from the beginning.